Welcome back to our channel. Today, we're diving into a crucial topic that could dramatically impact your financial future: 18 things you should avoid if you want to be rich. In this video, we'll explore common pitfalls that can derail your path to wealth and provide practical tips on how to steer clear of these obstacles. Whether you're just starting your financial journey or looking to refine your strategy, this video is packed with insights tailored just for you. Let's jump right in. Number 1. Living beyond your means. One of the most common traps that people fall into is spending more money than they earn. This lifestyle not only prevents you from saving but also leads you into a cycle of debt. High living costs, such as expensive housing or luxury items, can seem like symbols of success, but they often hinder genuine financial progress. It's crucial to assess your expenses critically and ensure that your lifestyle aligns with your actual income. Number 2. Neglecting savings. Savings are the cornerstone of financial security. Without an emergency fund, you are just one unexpected expense away from potential financial disaster. Regular savings contribute not just to your emergency fund, but also to your long-term financial goals, like retirement or a down payment on a home. Start small if you must, but the compound interest over time can turn even modest savings into significant sums. Number 3. Ignoring debt. Debt, especially high-interest debt like credit card balances, can grow faster than you might expect. Ignoring your debt can lead to a damaged credit score, increased interest rates, and an overwhelming debt burden that can take years to clear. Tackling your debt aggressively by prioritizing high-interest loans and making more than the minimum payments can save you from a lot of financial pain in the future. Number 4. Skipping budgets. Many people view budgeting as a restrictive practice, but it's actually a tool for financial freedom. A budget helps you track your income and expenditures, ensuring you can make informed spending decisions. It's about understanding where your money goes and adjusting those habits that don't align with your financial goals. With a clear budget, you can prioritize expenses, reduce wasteful spending, and accelerate your savings rate. Number 5. Lack of diversification. Diversifying your investments is akin to spreading your bets across different sectors and asset classes. This strategy reduces your risk if one investment fails, as others in different sectors or asset classes might perform well, balancing out potential losses. For example, a mix of stocks, bonds, and real estate can provide a buffer against the volatility inherent in financial markets. Failure to diversify can lead to significant financial setbacks if a single sector you are invested in takes a downturn. Number 6. Investing without research. Jumping into investments without adequate research or understanding can be akin to gambling with your financial future. Whether it's stocks, bonds, or any other investment vehicle, understanding what you're investing in and why it fits into your financial strategy is crucial. Informed investing means keeping abreast of market trends, understanding the financial health of companies you invest in, and knowing the risks involved. This foundation allows you to make decisions based on logic rather than mere speculation or hype. Number 7. Ignoring retirement accounts. Retirement accounts, such as 401ks or IRAs, offer significant advantages, including tax benefits, that can amplify your wealth over time. Contributions to these accounts often reduce your taxable income, and the compound interest over decades can turn these contributions into a substantial nest egg. Additionally, many employers offer matching contributions, which can accelerate your savings even further. Neglecting these opportunities is essentially leaving free money on the table. Number 8. Emotional investing. Making investment decisions based on emotions rather than data can lead to poor outcomes, such as buying high in a euphoric market or selling low in a panic. Emotional investing often results in buying or selling at inopportune times, which can undermine long-term financial goals. Developing a disciplined investment strategy that includes regular reviews and adjustments based on rational assessments rather than emotional reactions can significantly enhance your investment success. Number 9. Keeping up with the Joneses. The pressure to match your lifestyle to that of your peers or societal expectations can lead to significant financial strain. This phenomenon, often referred to as keeping up with the Joneses, involves spending money on high-end items or experiences simply to portray a certain image. This behavior not only depletes your financial resources but also diverts funds from more meaningful financial goals like saving for retirement or investing in assets that could appreciate over time. Number 10. Frequent luxurious spending. While indulging in luxury goods and services occasionally is not harmful, frequent luxury spending can become a substantial financial burden. High-end gadgets, designer clothes, and luxury vehicles come with hefty price tags and often depreciate quickly. Such expenditures, if not kept in check, can drain your finances, leaving little room for investments that could actually increase in value or provide returns. It's important to evaluate the true value and necessity of luxury items in relation to your overall financial plan. Number 11. Not investing in yourself. Investing in personal and professional growth often yields the best returns. This can include pursuing further education, acquiring new skills, or even maintaining your health. Such investments enhance your earning potential and open up new opportunities for financial advancement. Neglecting this aspect of self-care can limit your career trajectory and, by extension, your income potential, which is critical for building wealth. Number 12. Ignoring insurance. Many people underestimate the importance of having adequate insurance coverage as a part of their financial plan. Without proper insurance, be it health, home, or auto, you are exposed to potentially catastrophic financial risks. For instance, a single medical emergency without health insurance can lead to enormous out-of-pocket costs, which can wipe out savings quickly. Therefore, it's crucial to assess your insurance needs carefully and ensure that you are adequately covered to protect against unforeseen financial shocks. Number 13 is short-term mindset. Focusing solely on immediate gratification can severely limit your financial growth. A short-term mindset might lead you to spend impulsively, neglect long-term savings, or skip on investments that don't pay off instantly but are fruitful long-term. Building wealth requires a long-term perspective, where delayed gratification and patience are crucial. This involves setting and sticking to long-range financial goals, like saving for retirement or investing in stocks, which may not yield immediate returns but are essential for sustained wealth accumulation. Number 14. Fear of failure. Fear of failure is a significant barrier in making bold financial decisions that could potentially lead to high rewards. Many avoid investing in markets or starting a business due to the fear of losing money. While caution is advisable, excessive fear can prevent you from taking calculated risks necessary for financial growth. Overcoming this fear involves educating yourself about financial risks and opportunities and perhaps starting with smaller risks to build your confidence. Number 15. Procrastination. Delaying financial decisions can be as detrimental as making poor ones. Procrastination in managing finances, whether it's delaying investment decisions, failing to save regularly, or postponing the creation of a will, can lead to missed opportunities and financial complications later on. Setting up automatic contributions to savings accounts and investment funds can help mitigate this issue by ensuring that financial growth is continuous and not dependent on your daily decision-making. Number 16. Neglecting financial education. Continual learning is key to maintaining and expanding your financial knowledge. The landscape of personal finance, including tax laws, investment products, and strategies for saving, changes regularly. Keeping abreast of these changes is crucial. Lack of education can lead to missed opportunities or financial missteps. Regularly reading financial literature, attending workshops, or consulting with financial advisors can keep you informed and agile in your financial decisions. Number 17. Mixing finance with friendship. Loaning money to friends or co-signing loans can strain or even ruin relationships. Financial dealings between friends often lack the formal safeguards that institutional loans have, leading to misunderstandings and disputes over repayment terms and responsibilities. Furthermore, if a friend fails to repay a loan, it can lead to both financial loss and personal conflict. The best practice is to avoid mixing finance with friendship, or if you must, treat it as a gift rather than a loan to preserve the relationship. Number 18. Lack of charitable giving. While it may seem counterintuitive when discussing wealth accumulation, charitable giving can actually be a financially sound strategy as well as a fulfilling one. From a practical standpoint, many charitable donations are tax-deductible, which can reduce your taxable income. Ethically, giving back to the community can enhance your personal brand and open up networking opportunities that could lead to more financial or professional opportunities. Engaging in charity also brings personal satisfaction and psychological benefits, known as the helper's high, which can improve your overall well-being. This, in turn, could enhance your productivity and creativity, further boosting your financial capacity. Moreover, participating in charitable activities can strengthen your reputation in your community and industry, fostering goodwill and potentially leading to partnerships or client referrals that would not have arisen otherwise. If you find this video helpful, please hit that like button, subscribe to our channel for more financial advice, and ring the bell to get notified about our latest uploads. We love hearing from you, so please leave a comment below with your thoughts or any questions you might have.